Happy Monday. Welcome to Maine Management's weekly market note. I am Alex Varner, our head of research here at Maine, alongside
James Maxwell, VP of Research here at Maine.
So let's get into the note. We, usual performance slides here. Kind of mixed on the year to date still. The weekly performance numbers were definitely more positive than negative. Staples was the only sector in the red, down 1.3. Infotech led the way up, 8%. Consumer discretion up 6.6. So clearly some kind of risk on.
Kind of a reversal and back in some of the names in tech and consumer discretionary that saw the sell-off the past few weeks.
Yeah, and you've seen also year to date internationally, Europe continues to lead up, a big 17%. That's a huge number for through April 25th. Especially when you look at the gap relative to the S&P and the Nasdaq, which are down 6, 7, 8%. But again, more positive than negative. Although April is kind of heading towards potentially a third down month in a row. We'll see what the next couple days here do. But right now, I think we're down around 2.
I think the Nasdaq is up for April, which was
I think so. Yeah.
If you had said on April 2nd, April 3rd, when that massive spike down had happened, that it would actually end up positive, I think that would be very surprising.
People would have taken the other side of that one, I think.
But anyway, we can go on to the recession dashboard.
Recession dashboard here, we've seen a lot of blues. Things are kind of, probably going to trend sideways. And again, this is also part of being, looking at the data kind of for more than a month at a time, where you see where things are trending and what they're looking at. And for, the time being with so much uncertainty around the tariffs, trade, kind of economic growth, we get Q1, the first estimate of Q1 GDP this week. That's supposed to be pretty weak, like 0.4, I think. So again, a lot of it trending sideways, and hopefully they'll switch back to green. Kind of things will find their footing
as the clouds kind of clear out. Hopefully,
but so far we're everybody's still waiting on the clouds to clear out. On the data points last week, we got durable goods orders. Those kind of unexpectedly surged over 9% month over month. Core capital goods, though, which are a pretty closely watched business spending proxy, those were up just 0.1%. So while that headline number is good, the core capital goods were up less, and that's a little bit of a concern, although they've been kind of, eking out gains. So it's not a big change in the trend, but it did miss forecasts. And then X transports, they were up basically flat, up 0.03%. So the transports were a big role in this, on that durable, that headline number. And those can be quite volatile. They're like aircraft deliveries, that sort of thing. So they can be kind of clumpy.
Yeah, I know there's like the Boeing strike earlier that I think is affecting a lot of this. And then also, as you mentioned, the tariff kind of front running or front loading, where they're kind of trying to import ahead of tariffs and maybe try to sell those goods before any eventual tariffs kind of go into effect, or at least larger ones go into effect.
Yeah, so we'll see on that kind of where those settle. But again, as it's been this month, kind of waiting on some clarity around where and what levels tariffs are going to be actually implemented, and how sticky or persistent or they will be. So yeah, again, kind of more waiting and seeing. Sentiment is sour. It's been sour for quite a while. This University of Michigan, this was the final reading. It was revised up, which is good, but it's still, at the headline numbers at 50.8. Expectations are, were barely revised up, and they're at their lowest level since 1980, which kind of, is very pessimistic. But it is worth noting, they did kind of change the methodology for this survey, going from phone to also doing online, and looking kind of, they've run, kind of a regression on the difference between the before and after. And they say structurally, this one seems to be like 8 or 9 points lower, which is, worth noting when you're saying, oh, we're down and things are, continue to be lower on the sentiment side. I think online people are, just the difference in talking to somebody on the phone versus typing something into a window. You're more, it's a little bit easier to be more pessimistic.
Yeah, it's easier to say things are terrible when it's not a human asking you the question, when it's just a checkbox or whatever. I mean, but even still, even if the sentiment was 8 points higher, 9 points higher,
It's
it's
still low.
still very, very low.
Yeah.
Which I guess speaks to the absolute magnitude of how people are feeling.
Yeah, there's definitely just feeling an overweight or kind of overhang on their, over the clouds over their head, so to speak.
Yep.
And on the right, you can see inflation expectations have shot up. 1 year is at 6.5. That's the highest since 1981, and 5-year expectations are at 4.4. I also saw something. I think it was J.P. Morgan, where they had a survey of a couple hundred of their kind of clients, and they noted that inflation expectations were kind of becoming entrenched at 3% rather than 2 to 2.5. For a while, it had been 2 to 2.5, I think, and now it's kind of moved up to 3 as concerns around these tariffs and their potential effects.
Yeah, I think we spoke about this before, but the number one thing that the Fed is kind of looking at right now seems to be inflation expectations, because inflation expectations, according to kind of this theory of inflation, can lead to stickier inflation. If people expect prices to rise, then those prices kind of are self-fulfilling, where they rise because people expect them to. So that's kind of one thing that they're watching and that we're watching. The 1 year has really spiked up. A lot of that is because these one-off tariff price increases. The more important number are the longer term ones, like the 5-year or 3-year, which some surveys are showing spikes up, like this. It's at 4.4.
But the New York one is barely as high.
The New York survey of consumers is, I think, just right around 2 still. So it hasn't really budged. So kind of hard to see a trend in all that.
Yeah, and as we show here, there's also a big differentiation between political party. These are the kind of Democrat versus Republican breakouts, and really, Democrats have tanked since November. After Trump won the election, their sentiment has been far more unhappy, and their inflation expectations are also much higher. Republicans, I think, also are potentially calling for like 0%. And Democrats are at like 8 or 7. So there's a huge difference in your political leanings and the way you feel versus the way you express and kind of view reality. It is worth noting on the expectation side, though, the Republican sentiment has wavered a little bit there, which is not the case for the other two readings. Kind of shifting back to some hard data, we got existing home sales. They were down 6% month over month, kind of a little bit worse than expected. They're down 2.4 from a year ago, and basically it's kind of continues to be that high mortgage rate is weighing on existing homes, new sales, just everything. The whole market as a big kind of overhang on those 7%, 6-7% mortgage rates.
It just keeps it overall pretty frozen, where not a lot can happen in a 7% rate.
Yeah, and especially if you are somebody who bought a house before rates went up, the kind of opportunity cost and the switching cost is a big hurdle.
And it's now been years where people, rates went up. People said, okay, I've outgrown this house. I have a larger family. I'm just going to hold on to this and see what can happen. It's been now, over 2 years where people have held on to their, let's say, like smaller than desired homes and not wanting to leave those 2 or 3% mortgages.
They've tried to find ways to improve or expand or renovate. And
only so much you can do sometimes.
And on the right, you can see because of the kind of reluctance of people to move, it doesn't free up inventory, and so supply is constrained and prices have gone up on the median existing home prices. That 12-month average, you can see it's very seasonal on the dark blue line, but that dotted blue line is the 12-month average, and it's just continuing. It's at a slower slope, like a less aggressive slope, but it's still up and to the right, and the prices are up 3% from a year ago and have been positive for year over year for the last couple of years, so continuing to rise. New home sales unexpectedly accelerated. Again, these are home builder that are building new homes and creating supply, which is needed. But the result is, again, these are kind of they've been sideways, choppy sideways because of the high mortgage rates, and the prices have actually started to trend lower on the median new home prices. They're down 7% from a year ago, and kind of they've come from $460,000 down to close to $400,000, so 12% drop from the peak on a month-to-month basis. So you've seen kind of a different dynamic there, and again, that's people not kind of wanting to go take out a 7% mortgage.
Yeah, I think on the new homes, it's a lot of the home builders are trying to cut prices, offer incentives, et cetera, to drive demand, because without that, it's not really there.
Yeah.
With such high rates, so that's why you're seeing the price drops. But still, like even still, mortgage rates in April are right around 7%. There's not really
End
there's
in
not a
sight.
drop. Yeah, there's not really an end in sight. So it's just something to watch. I know that Bessent and the Trump administration have said that they want 10 and 30-year rates lower, which obviously feed into mortgage rates, but so far that's not really been
And you
the
kind of
case.
look at that as a catalyst for that is well, maybe you get slower growth, which brings yields down, but also you could look at a Fed cut depending on where, if inflation starts to, but then if inflation starts to rise, then the cutting is not what the Fed should be doing. So they're kind of, they're happy to play their data dependence card for now because nothing has really forced their hand. But at some point, they're going to have to make a move. And we'll see where that goes. For what it's worth, on the total home sales, that's new and existing. New homes are at 15% of total sales, so they're a fraction of the market, but that has been trending up. They were down at 5% back in, I want to say, 2010. And then on the right, you can see supply has been increasing. That's based on it's the number of months that current inventory would take to sell out. So go from whatever it is to 0. The existing homes are at 4.6 months, while new homes are at 8. And it's just, these homes are sitting on the market longer. And the inventory is kind of steadily building as people are still unwilling to come off the sidelines and and
actually commit.
And commit and take out a 30-year mortgage at 7%. So, we'll see if that kind of sideways upward, or sorry, that upward trending move in the inventories continues. But at a certain point, prices, we see it on the new home side that the existing homes kind of start to falter. Maybe it'll bring some people off the sidelines on the lower prices. And then, one more housing data point, where the building permits. And again, you can see these have kind of been trending mostly sideways. The single family homes account for the bulk of it. It's roughly 2/3 of the total permits. They were revised slightly lower, but that, positive reading on that headline number breaks, 3 down months that we had. So it's good to see those kind of tick up. But these kind of, feed into the new home construction.
They're supposed to be, directly leading where people get the permits to build the homes and then they finish them.
So you'd like to see this start to kind of meaningfully move higher. But again, since kind of those 21, 22 peaks were clearly below those and have been, kind of just treading water here. And finally, we got the flash PMIs for April. The finals are out this week. But they were pretty mixed. On the the U.S. kind of improved unexpectedly on the manufacturing side. India, Japan, and the Euro area were also higher. On the services side, on the right there, the U.S. fell to 51.4, missing forecasts for their 52.5 reading. Only India and Japan moved higher on the flash side, with Germany, UK, and Euro area all below 50, which is in contraction. So, and the service sector is the bigger part of these economies. So we omitted the composite numbers here, but essentially the composite numbers go as the service sector numbers go. But it's, again, you can see it's kind of things hovering around 50 plus or minus a point or two.
Especially the manufacturing side of the U.S. has been interesting to watch, because a lot of these tariffs, it's kind of funny, the part of the tariffs are to encourage industrial production domestically. Then there's obviously the issue where these companies are importing goods and maybe doing the final assembly here in the U.S., and the importing of those goods is becoming more expensive, more uncertain, even if they're doing the final assembly. So it's kind of been a mixed bag where some firms really stand to benefit from kind of that increased protectionism. Other firms, it's like their entire business model is importing goods, putting them together, and then selling those. So I know the ISM PMI, I think, is this week. That'll be interesting to watch on the manufacturing specifically.
And we've seen in the regional, they do have five regional feds, and those respondents, the prices received and prices paid indexes are jumping back up again on those as these firms are kind of forecasting. They're seeing that they have to pay higher prices for raw materials, and they're charging higher prices, and basically which means they're passing those input costs through. And those price levels are back at their, kind of when we were coming off of the the pandemic bubble,
Mhm.
where that was because you couldn't get anything because
Mhm.
everything, it was the supply chain issue,
shortages.
yeah,
Yep.
shortages, and now it's not supply chain shortages, it's kind of imposed price increases
Yeah.
that don't necessarily aren't playing by the kind of traditional
Mhm.
laws of supply and demand.
Yeah. The other thing on those regional Fed PMIs, the CapEx
Mhm.
plans, I think have been really weakened because that goes back to the uncertainty where these companies don't want to build out new factories,
Yep.
new plants if they're not sure what the exact kind of business model is even going to look like in
Yeah,
12
and if
months.
they're already paying more for inputs, then
Yep.
that's less money to go towards CapEx.
Yep.
And again, yeah, the uncertainty really makes it hard to plan. If you're going to build a factory, that's 2, 3, 4, 5 years
Yeah.
down the road
Yeah.
potentially. And if you don't know what that roadmap looks like, it's kind of a big ask
Yeah.
to outlay all that
Yeah.
cash to build something that you might not need, or or it might put you out of business depending on what kind of where these things play out. So we'll see. Yeah, we'll see the final readings of those this week. We also get, as we mentioned earlier, the Q1 GDP, non-farm payrolls, income and spending, core PCE. So it's a pretty data-heavy week to kind of close out April and take us into May. Here's our kind of summary slide. Again, we mentioned JOLTS, GDP, PCE, and non-farm payrolls on Friday. And that's about it for this week.
Yeah.
Thank you for joining us. Hope the weekend was great and have a good start to your week.
All right. See you all next week.
Thank you.